Hey everybody, this is Max here with Ninjacators, and I wanted to make a educational video on the advantages and risks of trading futures. Let's get going. As always, information in this video is provided for educational purposes only. It's not an offer or recommendation to trade futures, stocks, options, or Forex. Purely for education. So first, it's important to understand what is a future. People hear the word futures often and they're like, what in the world is that? So a basic definition of a future is a contract. It's a legal agreement to buy or sell, aka long or short, a particular commodity or financial asset at a predetermined time in the future. The underlying assets within the futures universe consist of financial instruments, which would be based off of ETFs, mainly the S&P or NASDAQ or Dow or Russell, as well as a lot of the bond and treasury instruments, as well as commodities, which would be metals, gold and silver, and crops, anything from wheat to orange juice, and oil and natural gas. There's all sorts. There's livestock. There's tons of futures contracts. A fun fact, futures were originally invented for farmers to be able to hedge their crop harvest schedule. So if they anticipated a down year, or if something crazy happened with weather and they weren't going to be able to be as profitable, and they could hedge their own physical business for whatever reason they saw fit. Advantages of trading futures. I personally think there's a lot. We'll talk through some of them, and it's just a great derivative product. First off, leverage. Futures are highly levered relative to buying like a ETF for any asset or commodity, whether it be the S&P or the QQQ. GLD with gold. If you buy one futures contract, you're going to have a significant amount of leverage. And the leverage is different between each product. They don't all have the exact same leverage. And we'll get into a little chart earlier. Definitely suggest whatever you plan on trading, whether it be all the different products, you definitely need to go on the exchanges, whether it be CME or CBOT, whatever exchange offers your product, and see how big the product is that you're actually getting into a contract for. But that's an advantage, the leverage. Liquidity. What is liquidity? Liquidity in simple terms is the ability to get in and out of position quickly and without a lot of slippage. Or you want the spreads to be tight. You don't want there to be, if it's a $1 product, you don't want it to be, this is just for simple math, you don't want the bid to be 90 cents and the offer to be $1.10. That's a big spread. You want it to be a $1 bid and a $1.01 offer. So you want that to be super tight, and these are very tight as far as liquidity goes, and they're always execution is pretty great. It's an advantage. Short selling. Unlike shorting stocks where you have to take on margin or borrow shares to be a short seller, futures allow you to just pay the contract fee to open and close. You pay a fee, usually pretty small, but definitely extremely small relative to how big the position is, and be short without paying the annualized margin fees. So if you open a short on a stock, your broker is going to lend you a stock and make you pay a certain amount of margin. This is often above 10%, depending on the stock and availability of the short, ability to short it. It could be well above 10%. So moving on. More advantages. No time decay. If anyone has traded options, which is a whole different beast, but the other big derivative product, options have something called theta, And theta is simply the rate that an option declines as the expiration date approaches. It's also referred to as time decay. This does not apply to futures, so that is wonderful. I think it's just much more simple to understand. There's not as many variables. Options are good for certain things, but for instance, if you buy an option and it expires this week and the market doesn't go up or down, your option is not going to be the same. Your option is going to go down because it's paying a daily theta. It's the time decay. So you're paying for the time holding that option. You're not paying for the time of holding the future. Next, favorable tax treatment. Futures are taxed at a blended rate of 60% long-term and 60% short-term capital gains. Doesn't matter if you open it and close it within 5 minutes, 60% of that is going to be taxed at long-term. Again, it's important to consult a CPA, a tax person, but this is a pretty simple law, but definitely if you're trading futures and definitely work with somebody, let them know, let your accountant know that you're trading futures because it is taxed differently. And next, the open market hours. It's open for longer than the stock market. So the stock market is open in Central Time from 8:30 to 3 every single day. And the futures open for 23 hours per day. They open at 5 p.m. on Sunday evening. That's Central Time. And they close each day. So market closes at 3. They will close at 4 to 5. So just 1 hour per day it's closed. And then it'll reopen at 5 p.m. Central every single day during the weekday. Of course, on Friday, once it hits that 4 p.m. close, it will then not open again until 5 p.m. on Sunday. The risks of trading futures. The first advantage, we spoke about leverage, right? Because leverage used in the right context and responsibly can be a great thing. But over leveraging, too much of a good thing can become a bad thing. So the risks with futures, over leveraging, you can take on more risk than you're comfortable with. And also that can lead to a margin call. That's no fun. Your account must maintain a certain amount of margin. Also, you can look at that as maintain a certain amount of cash to open the futures position. Margin requirements also differ between brokers. Some may require you to have 12,000 to keep an E-mini contract open, and some may be 15,000. So wherever you are trading, make sure you're aware of the margin requirements, or you may get liquidated, because if you get below the margin requirement, the broker will liquidate your position and possibly other positions to maintain the correct amount of cash in your account. This is just simply the brokers protecting themselves because your money's in their account. And then if you get too over levered and it goes down too much, that would be on them. So it's just a risk liquidation engine from their end. So make sure you know how much margin you need in your account, how much cash you need, or you could get liquidated. Contract specifications. And this is for the indices. There's so many, like we said at the beginning, there's gold, there's metals, there's oil, there's so many different types of futures contracts. So I got this from barchart.com. I believe you can find some on CME for the products that CME offers. May need to do some searching to understand how much you're playing with. But as you can see here, the margin is huge. The tick value is of the S&P E-mini is 50x. So every single point that SPX goes up is a $50 move with this futures contract. The NASDAQ, 20 times. That is a ton of leverage. Also, it's good to know that there are micro contracts. The micros would be 1/10 of this. So the micro E-mini would be 5 times the index, $5 per point. MNQ, the micro NASDAQ contract, would be $2 per point. So not quite as much leverage, but still, that is a minimum of 100% of the position of holding the underlying. And so now we'll get into an example of how fast this could happen. This actually happened today. We're recording this on January the 5th of 2024. This is how much money can move pretty quickly. So this is from 7:30 a.m. Central Time. News came out, and this is obviously just for a example. Comes all the way down. If you bottom tick this, you literally buy the bottom of it and hold it. This is till right at 10 a.m. So 2.5 hours. It's 242 points, which is a good move, but that happens multiple times per week in NASDAQ. It's nothing out of the ordinary. So it's a good move. That's $4,840 per contract in 2.5 hours. So that shows the leverage and how fast this can move just on 242 points. Again, you could do a micro contract, it'd be 484. Even just this pullback, I think it pulls back a little bit over 100 points. That's minus $2,000 if you buy the top. The risk, if it's 2-to-1, you're risking $2,420. It's a lot of money. So be aware of the size of the contract that you're trading. It's so super important. So the main takeaways, futures are a great way to hedge, to speculate, to get leverage within an account or a portfolio. Not only because of the leverage, but there's also the other benefits such as market hours, the tax benefits, and then the liquidity and spreads. Another huge thing, obviously we just kind of went through that with the last slide, the risk management is key due to the amount of leverage inherent in a futures contract. You can quickly get oversized and then get maybe a little over your skis. So risk management, of course. And then also be aware of the margin requirements with your broker. This is super important because it's different all over the place. There's no blanket, hey, you need this in your account to open the contract. Make sure wherever you are aware of that. So lastly, just trade safely and have a system. Ninjacators, we have a lot of really good stuff to offer as far as indicators and master classes, tons of stuff at Ninjacators to help you create a system and trade safely. But hopefully you learn something about futures. It's a wonderful derivative product when used correctly. So again, trade safely and have a system.